Yo, what's up, my fellow wealth creators? Matty Ice here. Really excited to do this video because I am officially starting my third year implementing the infinite banking concept. It has been a heck of a journey. It is awesome. I'm still a huge raving fan of it. And what I want to do with this video is just share my experience over the past couple of years going into my third year with this. I want to share just how I've used the policy, how I'm going to continue both my policies, basically my private banking system is the way I think about it, how I've used it and how I'm going to continue using it in the future. I want to share some of the primary lessons that I've learned over the last couple of years. And also I'm going to show you how my policies are performing as well. They're actually outperforming. We'll compare the original illustration with how they're doing right now, like dividends that are getting paid out and stuff. It's just been a really cool journey. And here's the thing, guys, while I'm a huge fan of infinite banking, it's certainly not for everybody. And my goal with these types of videos is just to share what's working for me and my experience with this to help you make an informed decision. Maybe it's right for you, maybe it's not. But how do you know unless you do the research and see how other people are using it and comparing it to what your goals are and what your personal, financial situation is, right? You have to do your due diligence to truly figure out and decide and make an informed decision about whether or not something like this is right for you. We don't want to just mindlessly and blindly follow, gurus and influencers and stuff like that just because they say one thing is good and other thing is bad. Like, we need to do our own research. And that's why, like, don't take my word for everything. I'm just sharing my experience here. But take this stuff and this information and, the content in this video and go do your own research and figure out if this is right for you. Because if it is, it can absolutely be game changing, guys. It has been in my life so far. And that's why I'm so passionate about sharing this stuff. All right. So let me share my screen and we'll get into it. We'll have some fun. All right. The first thing that I want to break down is how I've used my own private banking system so far. All right. And how I'm going to continue using it in the future. So the very first thing that I did was I purchased my vehicle, which I still own today, free and clear. I've actually paid that policy loan off. Just anytime, I had extra capital, I would just put it back into my policy and pay that policy loan down, which means I'm paying less policy loan interest, obviously. And now I own that vehicle free and clear. The great part about it was my money continued, my cash value in my private banking system continued to compound, even though I used the policy loan to purchase the vehicle. But because it was the life insurance company's money, my cash value continued to compound. So I purchased my vehicle. I did a video on this the other day talking about like how, purchasing a vehicle is, I wouldn't say it's the best way to use a policy, at least for me. But I guess in my situation it was a little bit different because I see, here's the thing. I'm a big fan of using policies to acquire assets and accelerate the wealth building process. But that doesn't mean that we can't use it to purchase a vehicle. It's still, in my opinion, the most efficient way to buy a vehicle. So if in your particular situation, purchasing the vehicle is the next major move for you or the next major purchase, it could absolutely be a viable option. So I purchased my vehicle with it. I flipped 2 forklifts. So I was like flipping heavy equipment for a little while and I made profit on the first one. I think I broke even on the second. I think I did a little bit of profit on the second one. But I'm no longer flipping heavy equipment. Because if it takes too long to flip, then the policy loan interest continues to accumulate, and that starts to eat into the into the net profit, obviously, which it's a lot different with real estate. That's why I transitioned over to real estate. So a good strategy if you can flip the forklifts in time, but the second one it just took longer than I wanted it to. I didn't have as much profit, which means that locked up my capital and I incurred opportunity cost because of that. So it was a learning lesson. I didn't lose money on it, but I didn't make as much as I wanted. It was a good introduction into using the policy and starting to implement infinite banking. But I had a good experience with it, but that's when I transitioned into doing real estate and actually lending on real estate. And I am currently about to complete my third real estate loan. Probably within the next 3 weeks of doing this video, we should be closed. And it's actually going to be my best deal so far. I'm going to net probably about 5,500 over the course of about 90 days. And I didn't have to do any of the work. I was the bank, right? And I'm making money twice because, again, my cash value is continuing to compound in my policies, in my private banking system. I borrow against it. I lend that out at a much higher interest rate than what I'm being charged, which is roughly about 6%. I lend it to my investor at 13% plus a point, and I keep the spread. It's freaking awesome. And I'm building wealth twice in two places at once. So far, across those 3 deals, I've earned roughly about $13,500 of interest. That's net after the policy loan interest. And this does not include what my policies grew by during the same time frame. All right. So I wouldn't say this is like life-changing money, but it's passive. And that's a pretty decent amount of money. Let's see, I've been doing real estate deals for about a year and a half now, not like back to back to back. So there was some time in between. So I probably could have earned more like between doing deals. So I probably could have earned a little bit more interest there if I was a bit more consistent, but I had other things come up that I was using policies for. So it's okay. You don't have to do deals back to back, but across the 3 deals, $13,500 net profits on these deals, like completely passive for the most part. I think is pretty sweet. I think it's a very effective way of putting money to work and using our policies, because I'm in a first lien position, just like a bank would be. So if the investor did not pay me back, I could foreclose on the property, sell it to recoup my initial investment if I wanted to, or if I had to. I don't want to do that, but I don't anticipate that happening anytime soon. So I am going to continue lending on real estate. And when you lend on real estate this way, like I've done other videos on this where it just like significantly increases your rate of return, plus you're earning money in 2 places at once. All right, so really great way to build wealth, in my opinion. Consolidated debt for 2 people that are close to me. This is probably what I'm most proud of. I'm starting to like this private banking system, this strategy, infinite banking. It's not changing just my life. It's not just helping me accelerate the wealth building process in my life. It's also changed the personal finances of a couple of people close to me. And I plan on continuing that process as well, like helping those close to me who need assistance to, put themselves in a better financial position, right? So on 2 occasions, I consolidated 2 people's debt. The first one was for $12,000. I put $800 per month back into her pocket. She was paying like $1,200 a month just on the minimum payments across over 10 cards. It was crazy. And now she pays me back $400 per month. So she keeps the spread. So it put $800 a month back into her pocket, and she's just paying that back over time. Her credit score is above 700 again. And then on the second, the second consolidation for this person, it was a different person, but we consolidated $20,000 of credit card debt. He was paying about $1,000 a month on minimum payments, and he's paying me back $500 per month. So that puts $500 a month back into his pocket. And he texted me, it was a couple of weeks ago. His credit score has increased by about 100 points just in a couple of weeks. Like, we're talking about putting money back into people's pocket and improving their credit, like significant changes. With this type of stuff, guys. And it's here's the thing, my money's continuing to compound in my private banking system. This impacts me. This does not impact me whatsoever, other than I have some of my capital tied up in these particular deals, in these consolidations, but I have enough capital within my private banking system that I can still build wealth and lend on real estate. So if I wasn't able to do that, then maybe the situation would be a little bit different. But like, for example, on this second deal, he's actually paying me 12%. So I'm paying about 6% on the policy loan. He's paying me 12. That might sound like a lot, but it's not. It's not even close to what he was paying on his credit card, 25, 30%. And it's amortized out over, I think we did 3 years. So it's a much better situation for him. And I'm recouping some of that potential lost opportunity costs as well, where I would normally lend that out on real estate at 13% plus a point. That's usually what I do with my real estate deals. But he's basically covering some of that lost opportunity cost by paying me more than what it cost me to do the deal, right? So everybody wins. This is a win-win-win-win-win-win-win scenario. Like, nobody loses in this process. It's just incredible. So this is how I've used my policy so far. I'm going to continue, like my primary goal, wealth building strategy is going to be to continue investing in real estate It's very passive. It allows me to continue working on my businesses. And yeah, it's just awesome, guys. I freaking love it. All right. Primary lessons learned so far: respect opportunity cost. So there's a couple instances where, like, especially in the beginning when we set this up, like I was really excited to start using my policies and implementing this strategy, and that's great. But we want to make sure we're being strategic with our policies, respect opportunity cost. And I actually missed out. This is one of the reasons that it was one of the gaps, I would say, with me doing real estate. Like I should be on my fourth deal right now, but I'm only on my third because I wasn't able to, I didn't have enough capital available in my private banking system within my policies because I had used it for something else. And I unfortunately didn't have enough capital to fund the deal that my investor needed. I missed out on that opportunity. So what's the opportunity cost of that, right? So, make sure that you're analyzing opportunity costs. Make sure you know exactly what you're setting your policies up for, and just respect that opportunity cost. All right. We don't need to use our policies for everything. I remember the second policy loan I took was to invest in my business. It's like $3,000 I took, and I invested in like tools, equipment, software, and maybe a little bit of training as well. But then I was like, did I really need to do that? Not really. I could have just paid cash for that, and I could have that capital available for a better wealth building opportunity. So, we don't need to use our policies for everything, guys. Like, make sure that we're using it to accelerate the wealth building process, recapture lost opportunity costs with these large capital purchases, like buying a vehicle and stuff like that. Right. I've also learned that this is definitely not for everyone. When I first started this, I was like, man, everybody needs to do this. And I guess a part of me still thinks that everybody should at least research it. I don't think everybody should do it because not everybody is, can I just be blunt, financially responsible. Not everybody's financially disciplined enough to implement a strategy like this. Because like if you are frequently spending more than you are earning, let me see if I can turn. I think my night light just came on with this. Let me adjust this here really quick, guys. Just bear with me. Yeah, like if you like people that are consistently spend more than they earn, they can't save money on a regular basis, or they don't want to take a lot of responsibility for their finances. They want to just sock money away into a 401k and pray that the market does what they need it to do, and that over 30 years, and then they'll be rich and sail off into their retirement years. Then this is definitely not for you, because this is an active financial strategy here. We don't put money into a policy and then just let it sit there. I just don't think that's a very good. I mean, I suppose you could, but I don't know that is the best way to do this. Like, this is an active strategy where we're building a private banking system, and we're going to use the capital within the policy in a very strategic way to build wealth and recapture lost opportunity costs, among a couple of other things. So so it's definitely not for everyone. I think everyone should at least research it to determine if it's a good fit for you or not. It can be very powerful for a lot of people, I think, but it's certainly not for everybody. Don't overestimate how much you can fund your policies too. Start small and build up with additional policies later on. I would say I was probably a little more aggressive with the policy design than what I should have been, meaning that like we'll get into the numbers here, and I'll show you my illustrations here in a second. But like, for example, my first policy, I put 120,000 in the first year. So I did a pretty massive front load, which was awesome. That supercharges the policy. You're compounding a much higher number as well that you're starting with, and it's a great way to get very, very high early cash value. And then that one I set up to be able to put $25,000 per year in. My minimum is like $6,200, which is fine. So I still have a lot of flexibility. And then my second policy, I did $80,000 the first year. It's gonna be $20,000 per year after. I think the minimum on that is like $5,200, I think, give or take. And at the time, my marketing agency was like absolutely crushing it, and it's still doing good, but it has dipped. We're recovering right now. Like, that's just the business cycle. It is what it is. Still doing fine, and I'll be able to fund the policy the way I designed it for the foreseeable future. But I probably would have set the recurring annual premiums a little bit lower if I had a do-over. I certainly don't regret it, but my point here is that the lesson is, like, don't overstretch yourself with this, even though we have some flexibility, like I don't have to put $25,000 per year into my first policy if I don't want to. I could just put in the base premium and maybe a little bit more above the paid up additions if I wanted to. It's not ideal. You don't want to be in a position like that if you don't have to. There's some workarounds, but my point is, don't overestimate how much you can fund. Be be conservative with it. Stretch yourself a little bit. I would say it does motivate me to continue making sure that I'm doing really good in my business, and so I can put as much money into these policies as possible. But just be conservative when you're designing policies. That's all. And discover your investor DNA. What is going to work best for you when it comes to utilizing your own private banking system here? So like I was saying on the previous slide, where I took a policy loan to invest in my business, and then I was flipping forklifts and stuff. And here's the thing, I didn't really have much interest in flipping forklifts. It made sense to me from a business standpoint. And, I wanted to implement the strategy, and there was nothing necessarily wrong with it. But, looking back on it, that didn't really fit my investor DNA. Real estate, like lending on real estate, was what I really wanted to do. And that just makes much more sense to me. I'm much more comfortable doing that. And so you want to figure out what your investor DNA is when it comes to how you're going to use your policy. So start to think about that. Is it going to be investing in your business? Is it going to be, investing in real estate, high income ETFs, stuff like that, right? You want to make sure you analyze that really well, right? So you're very clear on how you're going to be using the policies. All right, so those are some of my primary lessons that I've learned so far. Let's talk about some fun stuff here. Some really fun stuff, how my policies are performing. So I'm going to break down just an overview here, and then I'll show you the illustrations. We'll do some comparisons. All right, so far, as of today, I have funded roughly, it's about $270,000 that I put into both policies. So my entire private banking system here. Total cash value available is roughly $251,000 at the moment. I do currently have an outstanding policy loans for my third real estate deal. Once that's done, I pay everything off, and I'll have a little bit of a clearer idea, or better idea of what this exact number is, because it's a little skewed with interest that I owe on the policy loans, but sometimes it's not an exact number on what you owe. So it's a little off, but this is roughly what I have available. So I am still in the negative at the moment. With that said, my first policy, Lafayette, is actually scheduled. I think I'm going to break even by the end of this third calendar year implementing this, because my policy is actually outperforming. I'll show you the numbers here in a second. So I'm pretty sure I'm going to actually reach my break-even point on year 3, at the end of year 3 of my policy, guys. That is incredible. If you can break even in 5 to 6 years, which is what my second policy is likely going to do, then that's usually the average. You're doing pretty good there. Some policies I've seen don't break even until 10 or 15 years. Those are the ones that are not usually designed very well. My first policy, about to break even in year 3, meaning I will have access to as much cash value, as much capital as I've put into the policy, guys. That's incredible. And here's the thing, the naysayers, oh, look at you, you're down $19,000 or whatever. It's okay. But the way I treat this is I treat this like another business, guys, like my banking business, my private banking system, I'm treating as a business. And what happens when you normally start a business? There's capital involved. You have to have capital to start your business. You're usually going to be behind for a few years, and it takes a little bit of time to recoup your initial investment. That's how I think about this. I'm thinking about this in the long run. Am I willing to take a short-term hit to have massive long-term benefits? Yeah, absolutely. Not to mention, I've made almost that much on my real estate deals, flipping the forklifts and all that stuff. So I've technically recouped the majority of my initial investment. It's just not showing up in equity in the policies yet. But yeah, I'm not worried about that at all. These things are outperforming already, and so I'm gonna hit that break-even point very, very quickly. But even still, you don't need to hit your break-even point to start using the policies. I'm already doing real estate and stuff like that, right? So really powerful. Let's see what else. So this is Lafayette Life Insurance Company. That's what LLIC stands for. This is the first policy that I set up. The dividend rate has gone from 5.2% to currently 5.75%. I'm not sure if they're increasing it again or not. Interest rates are starting to come down, so probably not. But yeah, this is one of the reasons why it's already outperforming. This recently, I just received my second dividend. I'm going to do an entire different video just on this one policy and the dividend that I received. But it was about $700 higher than what was initially illustrated, right? Pretty sweet. And then the same thing with One America. That's the company I set my second policy up with. I received a higher dividend than originally illustrated as well. The surplus amount that you'll see here in a minute is not as high or good as Lafayette. That's because One America has a much higher guaranteed rate. All right, so let's break down the numbers here. Let me show you. Let's see. Actually, let's start with the original illustration here. So, and then we'll make some comparisons. So, what I really want you guys to see is what my annual dividend was scheduled to be when I initially set this policy up. All right, so this was my original illustration. All right, like I told you, I put 120 in the first year, doing 25 up to 25,000 per year after that. I'm not on the hook for that. All right, which in fact I'm going to show you where my dividend is at. My dividend amount for Lafayette, I could actually start doing a premium offset if I wanted to, meaning I could use the entire dividend to cover the minimum base premium that's due every single year, which I think is like $6,200 or $6,400. My dividend will now cover that. So I could do a premium offset and never make another premium payment ever again. And my dividend will make the premium payment for me, and anything left, I believe I can still put into paid up addition. So the policy would continue to grow, just not obviously as fast as what I have illustrated here. But that is an option. That's freaking crazy. My dividend could already cover my base premium in this policy, guys. It's ridiculous. All right, but here is the second dividend that I was supposed to receive was $5,400, so $5,414. If we go to my statement here, what does this say right here, guys? 6,000. So your total dividend this year, $6,146. So we are roughly about a little over $700 ahead already. And you can see the total dividends that I've received so far, $10,759. We'll call it $760 there. And I anticipate this is going to continue to outperform because this illustration was done like this 100% of the dividend scale was when the dividend rate was 5.2%. Well, it's at 5.75% now, guys. So what's my next dividend going to be? Well, it was originally illustrated to be $6,355, but I'm already $700 ahead, plus the additional amount of dividend, the extra 5.5 basis points. Did I say that right? 55 basis points, sorry. All right. Is my next dividend, what's that going to be? Is it going to be 800, 900, 1,000 ahead of what was, or more than what was originally illustrated? So maybe 7,200, 7,300. Drop a comment down below and let me know what you guys think it's going to be. All right. And yeah, that's why I like when premium payment date is like my favorite day, because I'm putting more capital in my private banking system, but it's also when I receive my dividend and I can see my policy outperforming. It's really cool. All right, so we're already way ahead of schedule. And like I was saying, guys, I can actually cover the minimum base premium for almost anyways for this policy. Okay, so my minimum right now is it was higher than what I said. So it's roughly $7,000. But my next year's dividend is going to be probably over $7,000. So if a scenario came up where, let's say, the sky is falling in my life and my business just implodes and I have no capital left and I'm just screwed. All right, well, I don't need to screw up my private banking system. I could say, hey, you know what? This is a really, really tough time for me. Take my dividend instead of purchasing paid up additions. Let's do a premium offset and cover the minimum required annual premium there. And then anything left over, if we can, purchase the paid up additions. That's a lot of flexibility, guys. It's one of the reasons I love Lafayette too. The dividend it tends to be really good. One of the reasons is because they have a lower guaranteed rate. I think it's 2%. But anyways, super powerful stuff, guys. So that's my first policy. It's kicking rear ends right now. Okay. And then let's go to what do we call it? One America. All right. So this was my original illustration with One America. And on this page, I'm sure this is where it shows the actual dividend. So my first year's dividend was $627. And what I actually received was $710. So you can see like this is the surplus amount. So it's different because, like I mentioned earlier, One America has a higher guaranteed rate. I think it's 3.25%, which means they're going to have a lower surplus amount, which is what we're seeing here. All right. I'm pretty sure I'm describing that right. Anyways, that's the discrepancy, but it's still outperforming. And I haven't received my second dividend yet from One America. That's coming up in February. That's what this one is. And that will start the third year of my One America policy. But I'm scheduled in February to get, based on this original illustration, $806 for the dividend. What is that going to be? I'm already ahead. Is it going to be $900, maybe $950? We'll see. The reason I can't show the dividend rate on One America is they don't declare like a specific dividend. They just they declare the amount, but I'm saying like a dividend rate, right? They don't really play that game, which I can respect, because the dividend rate can be misleading sometimes, especially the way that it's marketed by a lot of people. Like that 5.75%, that's a gross number, guys. That's not what my policy is growing by every single year. That's before the costs and expenses of the company, and then the dividend gets dispersed to the policyholders. All right, but overall, I'm very, very happy with this. Everything is both my policies are outperforming. I'm using the policies actively in real estate in a way that makes perfect sense for me right now, because it's completely passive. I can put money to work, earn money in two places at once while continuing to work on my business. That is like a dream come true for me. And one other thing about the One America policy is, depending on, like, I don't like timing the market, like the stock market or anything. But one thing I really do like about One America, guys, is this indexed dividend option. Like, we don't have to use it, but this is an option. It's one of the reasons I think this is a fantastic alternative to this IUL crap, index universal life insurance, all this upside potential, downside protection, whatever. But it has so many things that can go wrong with it. With whole life, it's a lot simpler, and you can actually take your dividend, have the company use it to purchase options on the S&P 500, and you could potentially, so the maximum multiplier here is 2. So I could potentially double my dividend if the S&P 500 in that calendar year did at least 10%, like increased in value at least 10%. That's what this part is. Then I could double this dividend. So, even though the surplus amount is a little bit lower, I have the option to use this particular rider right here, indexed dividend option. Use that to purchase options on the S&P 500 and potentially double it, right? And the worst case scenario is I lose my dividend, which would suck. But my policy would still grow. It's still guaranteed to grow every single year. And I don't have all the potential issues with freaking index universal life insurance, So anyways, I will go ahead and wrap up with that, guys. I hope this was helpful. Hopefully gives you a little bit more insight into how this private banking system works, this infinite banking strategy works, how it's just basically what my experience is so far, and how I'm utilizing it, so you can decide whether or not it's a good fit for you. I freaking love it. This is my favorite financial strategy, and I think it's a great way to level the playing fields in a system that is designed to extract as much wealth from us as possible. This really puts us back in the driver's seat to allow us to take back control of our money, build wealth in multiple places at once, absolutely crush inflation, and tell Wall Street to take a hike, where we're in control here. So I love it, guys. I don't know about you, but this stuff I think it's just amazing. So anyways, would love to hear your thoughts, your feedback. If you have any questions, drop some comments down below. Make sure you take advantage of all the additional training and resources that I have for you in the description. I have a free infinite banking masterclass, as well as a book coming out very soon. So once that's out, I will put the link in the description and probably the comments as well. I'll pin it in the top comments. So if you'd like to get that, I would appreciate the support, but it's chock full of just great information on this stuff. So hope you guys are crushing it, and I will talk to you in the next one. To your success, Matty Ice is out.